Did you know that 70% of businesses put on the market don't actually end up selling? My name is Jim Frey with PC Investment Bankers, and today we're going to be talking about 4 key reasons why a business might not be able to sell. The first key reason why a business might not be able to sell is due to an owner harboring unrealistic value expectations. It's common for owners to have an inflated perception of value due to all of the years they've spent nurturing and growing their business. But when you bring a company to market, a buyer is going to be more impartial. They're going to be looking at the cash flows that your business generates, both current and future. It's important for you to align your expectations of value with the market's perception of value. The second reason a business might not be able to sell is due to poorly kept financial statements. I've looked at quite a few financials, and I'll tell you firsthand that the detailed, organized ones are by far the best to deal with and tell you so much more about the business you're operating with. The same goes for buyers. And if you're keeping inaccurate, disorganized financial statements, it's going to make the process of understanding what your company's doing and how it's performing so much harder. So if you're not able to provide them accurate ones that they can be comfortable with, they're not going to be comfortable with closing the actual transaction. There's a million different reasons why you would want to have good financial statements just for sake of operating your company, but it's especially critical when you're trying to sell it. The third key reason why a business might not be able to sell is due to a heavy concentration of customers and suppliers. If you have a heavy reliance on a few key customers or suppliers, it begs a question for a buyer that says, what if that customer or supplier leaves the next day? How is that going to impact financial performance? And you have to ask yourself the same thing. It's critical to be constantly expanding your customer base as well as your supplier base. And if you can do that, it'll create resilience in your company and make a buyer much more comfortable in closing a transaction. The fourth reason why a business might not be able to sell is due to a lack of a transition plan. Sometimes we find that companies are heavily reliant on 1 or 2 critical people. Most often that is the business owner. When trying to sell a business, a buyer is trying to understand how the company will operate post-transaction and how they'll do it without the business owner. So if your company is heavily reliant on you and you don't have a strong management team to take your place post-transaction, it's going to make the buyer very uncomfortable. The important thing is to establish a strong management team that can take your place seamlessly through the transaction. Regardless of if you have a strong management team in place or not, and you're intending to close a transaction, a buyer will almost always request the owner to stay on post-transaction for a period of time to make sure the transition of ownership is pretty seamless. However, that period of time could be very different depending on if you have key people who can operate without you or if you don't. So if you have a key management team in place already, it'll significantly lower the amount of time you'll have to stay on post-transaction. These are just a few of the key reasons why a business might not be able to sell, but it's critical for business owners to keep realistic value expectations in mind, as well as keeping strong advisors in your court. That way you'll receive the most value for your company. If you like this video, please subscribe to our YouTube channel so that you'll be notified whenever new content is posted.